Okay, class. I thought a productive use of some additional time would be to review a few of the chapter questions at the end of Chapter 4. Of course, for your homework in Chapter 4, you'll need to do questions 29, 35, 36, 37, and 43. But I thought we'd walk through a couple other questions to make sure we're all understanding the concepts covered in the chapter. The first question we're going to look at is question 4-30. On the screen in front of you are the responses, the answers to the question. So I'd ask that you read along with your book, which has question 4-30, of course, in it, and we can read through. So 4-30 is going to ask, what will be the effect, either understatement, overstatement, or no effect, on the income of the present and future period if the following errors were made? And so number 1 says, revenue has been collected in advance, but earned amounts have not been recognized at the end of 2010. Instead, all of the revenue was recognized as earned in 2011. So if we collected some money from a good or service rendered, but earned amounts have not been recognized at the end of 2010, if we've actually earned some of that revenue, but we didn't record any of that revenue, we would be understating our income statement. So let's think through that. Let's say there was $5,000 of revenue that had been collected in advance. Our entry would be, we would debit cash or increase our cash by $5,000, and we would credit deferred revenue, the liability account, by $5,000. At the end of 2010, if half of that deferred revenue was earned, we would need to debit deferred revenue to remove it from that account and credit or increase our revenue account. So if we did not otherwise do that, we would be understating the income statement in 2010. So that would be an adjusting entry that would need to be made. In 2011, if we recorded all of that $5,000 as revenue, we would then be overstating the income statement for that period. Hopefully we understand that, and that's why question 1 has a U for understatement for 2010, O for overstatement 2011. Question 2 reads, revenue for services rendered has been earned, but the unbilled amounts have not been recognized at the end of 2010. So if the revenue for services has been earned, but the unbilled accounts have not been recognized. So what that's telling us is that we've performed some service, however, and hence we've earned the revenue, but the unbilled accounts have not been recognized. So therefore, we would again be understating the income statement in 2010. Okay, sorry for that pause. Slight technical glitch. So getting back to number 2, if we've earned the revenue but did not do the recognition of that revenue in 2010, we would of course be understating our income statement for that period. This question 2 implies that we would have recognized it all in 2011, year 2, which of course it was earned the prior year, so if we recognized it in a subsequent year, i.e. 2011, we'd be overstating the income statement for that year. Question 3 says, accrued wages payable have not been recognized at the end of 2010. So that implies that some wages were earned, let's say in December of 2010, and if we did not otherwise record the accrual for those wages, we would not be recording the appropriate expense for those wages, because let's recall that the entry to accrue salaries expense would be debit or increase salaries expense, credit or increase accrued salaries. If we did not make that entry in 2010, we would be overstating the income statement because we were understating expenses. Net income would effectively been higher than what it otherwise should have because we did not record all of the appropriate expenses. Again, question 3 implies that we would have then recorded those expenses the subsequent year, and had we done that, expenses in 2011 would have been higher than what they otherwise should have. So if expenses were higher than they should have, net income for that period would have been lower than what it otherwise should have. So we're understating the income statement in 2011. And finally, question 4, prepaid rent has been paid in the late part of 2010, but no adjustment for rent used in 2010 was made. So let's think about that. We recorded or we paid prepaid rent, let's say in December, for part of December, January, and February. If we did not record some of our rent expense for the part of December that prepaid rent related to, we would be understating our expenses. And if our expenses were understated for 2010, our income would be higher than what it otherwise should have, so we're overstating the income statement. And of course, the converse is true for the following year, in 2011, when we'd be recognized all of that rent expense related to the prepaid rent, including the piece from 2010. So hence we would be overstating our expenses for the period in 2011. If we're overstating our expenses, we are understating net income or understating the income statement. We're going to shift now to another question. So the next problem that we wanted to review together, and we will endeavor to do this, at least most of this problem, is question 4-31. What 4-31 is telling us is that this company has made some incorrect entries, and we want to walk through the impact of those incorrect entries and what they should do to in fact correct those entries. So if we look at question A in 4-31, a $10,000 purchase of equipment on December 30th was erroneously debited to long-term debt. The credit was correctly made to cash. So let's think the correct entry should have been to debit equipment for $10,000 and credit cash. If instead they erroneously debited long-term debt, in order to correct that entry, they would of course need to credit long-term debt and properly debit machinery and equipment. Cash, which is what they had paid for, was already correctly stated. B, a business made several purchases of fuel oil. Some purchases, $900 worth, were debited to fuel expense, whereas others were charged to an asset account. So $2,000 in total. An oil gauge revealed $400 of fuel on hand at the end of the year, and there was no fuel on hand at the beginning of the year. What adjustment was necessary on December 31st? So if we think about what happened, they purchased $2,000 worth of fuel over the course of the year, and at the end of the year, they only had $400 left. So therefore, they would need to have at least $1,600 worth of fuel that went through the expense account. If, in this case, and I'm sorry for stuttering here, $900 had already gone through the expense account, and we know that $1,600 in total should have gone through the expense account, and I arrive at $1,600 because they purchased $2,000 worth and they only had $400 left. If $900 had gone through an expense account and $1,600 should have, that means $700 should be going through an expense account. So hence the entry here is to debit fuel expense and credit fuel on hand, which in this case is an asset account, and it's asset account number 7 on the small chart of accounts. We're walking through this in a way where I'm presuming you all understand where I'm going, so hopefully you do, but we can continue. C, on April 1st, a business took out a fire insurance policy, 2-year policy, and the premium of $3,600 was paid on April 1st. Of course, the entry there then would have been debit prepaid insurance and credit cash for $3,600, and you would expense that $3,600 ratably over a 24-month period, which would be $150 per month. The payment was debited to insurance expense on April 1st. What adjustment was necessary on December 31st? So they erroneously debited it to insurance expense, and they should have debited it to prepaid insurance. Now, we've said that it's $150 a month to expense that $3,600 over the course of 24 months. So in the year at hand, you have 9 months of expense, which is $1,350 should have been expensed. Instead, they expensed $3,600, which means that $2,250 is overstating the expense account. So in this instance, we would debit prepaid insurance for $2,250, as that's the amount that's remaining at the end of that year, and take that money out of the expense account, hence credit the expense account for $2,250. Moving on to D. On December 1st, $6,000 was paid in advance to the landlord for 5 months' rent. The tenant debited prepaid rent for $6,000 on December 1st. What adjustment is necessary on December 31st on the tenant's books? So if $6,000 was prepaid rent for 5 months, that implies that rent expense is $1,200 per month. Thus, at the end of that 1 month period, we should be debiting rent expense for $1,200 and crediting or decreasing that prepaid rent account by the same amount. Going on to E. Machinery is repaired and maintained by an outside company on an annual fee basis. It's a $1,800 fee for the year beginning September 1st, and it was paid on September 1st and charged to repairs and maintenance expense. So if we think about that $1,800 fee, really was a prepaid fee, and the company should have debited a prepaid repairs and maintenance account at that time for $1,500, and then expense 1/12 of that, or $150 every month thereafter. So in the year at hand, we'd have September through December should have been expensed, which in this case would have been $600 of total expense. So at the end of December, they really should have had remaining in their prepaid account $1,200, with repairs and maintenance expense being credited to take it out for that same $1,200. We're going to pause there as we're coming to the end of this 15-minute session. I would encourage you all to, as you're going through the homework and listening to these, please do email me with any questions you may have. I will be away, but I will be able to talk on the phone, and certainly will be able to reply to your emails. These are some important concepts to be able to understand and to grasp, as it helps to illustrate your understanding of how debits and credits are going to flow through an income statement and a balance sheet, and how a transaction should be properly recorded to the right accounts. And if not done properly, it will have an impact, either overstating or understating the income statement. We're going to dig in the next section quickly to do an overview of Chapter 6, which is the next chapter that we'll be covering.